Thank you, Commissioners.
Okay. Next, we have representatives from Stifel.
So in the attendees, I see Bret Holland. We want to bring Bret in. And also Kevin Karen from Washington Crossing Advisors. Bret, anyone else I'm missing?
Gonna get some music, it looks like.
Bret, you're still muted.
Okay.
Hey, Bret's here. Mike's here.
All together, okay.
Sweet.
I apologize.
I can do the guitar too if you like.
That's okay.
What kind of music do you play?
I didn't know that picture was going to do the start.
Yeah, we have a time issue, but we'll have to put that on.
Country, rock and roll, what is it?
Okay. So who's going to kick this off? Is it Mike or
I
Bret?
can get started. That's fine. Sure. Thank you, Chairman. Today in attendance, myself, Bret Holland, Michael Battistelli, and Sonia Gross were here representing Stifel. Kevin Karan is here. You've seen Kevin before with Washington Crossing. He's a senior portfolio manager. And in the portfolio for the pension, they represent about 13% of the overall assets. So he's going to share some comments at the end, and we'll, if you allow it, we'll just kind of go through our normal procedure, and then Kevin will have comments at the end. So if you have your quarterly report, I'm going to ask you to go to page 1. It's the same page that we typically start with, if you can find that. It'll say page 1 in the bottom right-hand side. And this report, if you're looking at it there at the top left, says through 6/30, so it's through the second quarter, and Mike will have the numbers up through yesterday, up year-to-date numbers a little bit more so, but this was up through the second quarter. On that top left quartile of the page, top left section of the page there, it has the combined portfolio showing the performance. And again, this is for the second quarter of this year. Quarterly performance was 12.62%. And then year-to-date performance, so that'd be the first 6 months of the year, was negative 3.82%. One-year numbers, as you can see, is 2.16. And then we have the 3-year and since the inception numbers that are listed there as well. To the right of that line chart, we like to kind of touch base on a little bit there, just showing at the beginning of the quarter, the market value at the beginning of the quarter was $111,276,740. And then we had withdrawals of about 2.1 million, appreciation or growth of 13.9 million, with an ending balance again at the end of the quarter of $123,145,725. The column to the right of that is just a one-year number. Again, beginning balance of 129 million. Withdrawals over the last 12 months of 8.6 million. Appreciation of 2.6 million. And again, with that ending balance of 123 million. Any questions with that initially at all?
I have none.
Okay. Bottom left-hand side is just the last thing we'll touch base on. We mention this every quarter. Our report does not break out the REIT portfolio, the real estate investment trust. Right now it's showing down there as equities of 65.38%, stocks of 65%. If you break that down a little more granular, that percentage, excuse me, that's actually in stocks is 61.41%. And the REIT portfolio makes up 3.97, so around 4% is in the REIT portfolio, showing equities again of 65, fixed income of 32.04%, and then cash position of 2.57%. And Mike's gonna talk about the updated numbers. That's a little bit outside of the investment policy statement, and we have a small recommendation that he's going to go over with that. Any questions on the portion that I shared today?
I have none.
Okay.
No.
Thank you.
Okay, so the updated numbers I'm going to provide you, just keep in mind these are unaudited numbers. The numbers that Bret just went over are actually audited, but this is as up to date as we can get it. So year to date, we're actually a positive 2.06% year to date through yesterday, and the pension balance is 132,968,811. So obviously we've had a tremendous bounce back from when the virus and the pandemic started, and we're thankful for that. I think as Bret alluded to, the allocation hasn't changed dramatically from the end of the second quarter, but as Bret alluded to, we are making a small recommendation because we have had a pretty good bounce back, and because we are a little bit slightly outside of our investment policy statement, which again is a guideline we should have at the high end 60% in equities, not including the REIT portfolio, but just at straight equities. So our recommendation today is to take $2.6 million out of the equities and actually put that into cash for future pension payouts, monthly payouts. We feel like this time we've had a good comeback. We have an election on the horizon, not sure the outcome of that. And I think at this point that will get us, we'll have enough cash on hand to get us into the beginning of the year. I think that might be a smart move at this time.
Mike, Commissioner Litz has a question.
Yes.
Thank you, Mr. Chairman. Yes, I am having a hard time. It's a very loud echo with your presentation. I want to make sure I understood it correctly. Did you say 2.6 million from REITs to cash?
No, from equities, not the REIT portfolio, just from equities, from stocks.
Equities, okay. From equities to cash. Is that what you said? Okay,
Correct.
thank you.
Okay, Mike?
Yes.
Any
I'll make-
opposition to that change or that adjustment, or?
I'll make a motion to adjust our portfolio to put $2.6 million into cash from the equities.
I'll second the motion.
It's been moved and seconded. Mike, do you have anything else you need to add to that?
Now, the only thing I'll add is that, we did receive early in July, we did receive the annual ARC payment. So I do want to recognize that. It was $3,158,684 came into the pension plan as well. So the annual payment was made.
Awesome. It's a good thing to be doing. But the motion is to move into cash to cover expenditures and to get us more in line with our policy. Any further discussion regarding the motion? Hearing none, all in favor, please indicate by saying aye.
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 Opposed? So moved. Ready for the entertainer now, or?
Yeah. So at this time, we're going to turn over the rock star, Kevin Karan.
Thank you. All right. So I'm Kevin Karan, one of the senior portfolio managers at Washington Crossing. We're responsible for almost $6 billion in total assets under management, and we are grateful to the county for continuing to work with us to help you manage your pension. Essentially, the way we've positioned the portfolio assets over the last few years has been with an eye towards quality, which to us means low debt, consistent cash flows, and companies that generate strong profitability based on assets, meaning profits before the distortive effects of leverage. And this paid off very well this year. And I just want to give you a sense of what I'm talking about. If you look at the typical value manager through June, the typical value manager was down about 16%. And it has been a very difficult year for those, particularly for those parts of the market or those companies that are not particularly good quality. So if you look at what happened from December 31st through the March 23rd bottom, the best companies, the AAA companies like Microsoft and Johnson & Johnson, for example, down 19%, but the sub-investment grade companies, for example, companies that carried a single B rating, for example, were down 56%, with the average company down about 30. So a big difference in terms of what happened on the downside, and those numbers are staggering. So the amount of volatility that we saw in the first quarter was very significant. Fortunately, we've had a bounce back, which sort of evens things out, but we can't look past the fact that we're still in an environment that has tremendous amounts of volatility that needs to be managed. If we look at the bounce back, we'll see that through the end of July, those AAA companies were actually up more than 10%, but the single B companies, the lowest rated companies out there, were still down 37. So it's really been a very differentiated market this year, differentiated along lines of quality, and it's worked very well for us because for the last 3 or 4 years, we've been continually pruning the portfolio and moving it more and more towards quality. The other big thing that happened this year was we came into the year with a considerable amount of cash, north of 25%. As prices came down, we're always looking out 3 to 5 years when we're assessing the value of a company. And as prices came down, all of a sudden there were things that became better buys for us. So starting in March, we were able to put money out during the month of March. And we put money out and bought companies like LabCorp, Alphabet, Google, Cognizant, Snap-on Tools, Intel, Henry Schein. These are all companies, if you look at them, they're going to have less than about 30% debt in the capital structure, lots of free cash flow, very strong profitability. And we think that holding companies in this environment that can get through to the other side of what eventually could be a difficult period is really paramount to us here. We're still looking at a market that's fairly expensive. So it's important to us to celebrate the fact that the economy is getting better, acknowledge that, but recognize that there are still risks out there. There's still a lot of debt that has been accumulated in many companies out there. And we want to continue to be very mindful that quality is very important, particularly when times get tough. So we're going to continue with that emphasis on quality. We're still largely fully invested at this point in time. But we would be willing to take cash off the table if we found that there was, if we were no longer able to make the bullish case that we're making today.
Very good. Any observations or questions from, yes, Jamie?
Since you did that in March, you were able to get some values when the market was down. Now that it's bouncing kind of up against, a record market, it just seems for the last few weeks to be hanging there.
Yeah.
Do you have will you have a tendency to pull some of that back out because you're traditionally you're a hold cash kind of a manager?
Yeah, the thing that would lead us to do that there's a couple things that would happen. Number one, if we saw that their forward-looking expectation, if our expectations for their future profitability were actually to start to come down, that would be a cause for concern. The other thing that I really need to point out is that a lot of what's driving value today are two things at the market level. Number one, you have interest rates, risk-free rates that are at essentially record low levels. And what that does is it raises the future value of earnings, all else being equal. And then the other thing that's happened is that investors who have been, where confidence has been buoyed by very supportive fiscal and monetary policies, coupled with some trends lately that have been obviously better than when they were in the spring. Those factors, improving confidence, very low treasury bond yield, is helping to support valuations. In time, that could change, and if those factors changed, we would reassess our intrinsic value for the companies that we own, and that could be another thing that could lead to a change in what we hold. But we we're staying with where we are right now. And the one thing that I point out, if you think about it along two dimensions, there's one question which is always going to be, where are we going to get the highest return? So in March, when prices were very low, that was the question that led us to put money to work. But then there's another dimension about this that has to do with the quality of the assets that you hold. And while many managers say that they're focusing on quality because that's a very good marketing tactic, you'll find that many of them don't really follow through on investing in companies that have very flexible balance sheets or have lots of cash flow, lots of consistency, the kinds of things that really engender quality to us. So we have to always think about those two things. We're essentially fully invested right now. We have the ability to hold cash if we're concerned about valuations, but we're more concerned at this point about the quality and nature of the companies that we own. And that's where we're operating more in terms of making choices between companies.
Okay,
All right.
thank you.
Well, appreciate your the clarity that you delivered your report. We're very well acquainted with the concept of volatility management, so we could relate to your report very well.
Thank
Anything else for the good?
That's all we have.
Okay. Thank you very much. We appreciate your attendance and
Thank you so much.
very good.
Thank you.